I'm now going to introduce Rhys, but before we do that, one of the things we always put these disclaimers up. I don't know if you read them or not. I hope you do. They are designed to be read. One of the things we always say is if you're located in a jurisdiction where you're not supposed to be watching this, please switch off now. Invesco have asked us to sort of reiterate that point before we talk to them. So this is aimed at UK investors only. So let's now talk to Rhys. So as usual, please just sort of tell us about you, tell us about the fund, and then we'll get to some questions.
Great, thank you, James. Hopefully you can hear me okay. So my name is Rhys Davies. I'm a fund manager at Invesco, and I've been with the firm for over 20 years. So my background was as a credit analyst, which is the bond equivalent of an equity analyst, and that's still very much a lot of what I do on a daily basis. Is thinking about the companies that we're investing in, we're lending to through bonds. So today I'm here to talk about Invesco Bond Income Plus, which is an investment trust. The stock ticker is BIPS, and I'll refer to it as BIPS throughout. As the name suggests, BIPS is a bond fund with a focus on income and on paying that income as a steady level of income for investors. So I've kept this to just a few slides, James, which I hope will give a quick overview of the fund, the markets we invest in. I'll include a few examples of bonds that we own, and then why, hopefully, viewers will get a good sense as to why bonds today are a much better place to head for income than they have been for a long time. So starting with BIPS, and I would start by saying it is relatively unusual for a bond fund to be an investment trust. Most bond funds, and there are lots to choose from, are mutual funds or open-ended funds, but only a very small number of bond funds are investment trusts. And BIPS is actually the largest fund in that space. So from an investor perspective, you clearly have that benefit of being able to trade immediately because it's an investment trust. And then from my perspective as the manager, being an investment trust gives BIPS a few more powers which we can use. So namely, that's the ability to set a dividend target, is the ability to borrow sensibly, of course, to enhance returns, and the ability to focus completely on the long term. Because an investment trust is, as everyone knows, that's viewing this, it's a closed-ended fund. Essentially, we don't have to worry about money being taken out of the trust at a time when we would rather be investing, say, in a market downturn. So what is BIPS investing in exactly in the bond market? Well, we're buying mainly corporate bonds as opposed to government bonds. These are issued by companies. So many household names have issued bonds which we can invest in. For example, Boots, Morrisons, Center Parcs are all what we would refer to as high yield bond issuers. Boots recently issued a bond with a 7.4% coupon. That is, Boots will pay the holder of that bond 7.4% per annum for the life of the bond. Morrisons just pays just under 8.8% interest on its bonds. We're also investing in the junior bonds of banks like Lloyds and Barclays, where we can earn similar kinds of coupons to those that I've mentioned. And in my view, the point of a bond fund, any bond fund, is that it's giving investors access to the bond market. So for an individual investor, it is very hard to access the bond market directly. For example, the majority of sterling corporate bonds require a minimum of £100,000 investment. And then when it comes to bank bonds, the FCA actually prevents investment by individual investors into junior bank bonds, which is a whole topic for debate. It's certainly a questionable decision, I think, but at least they can be accessed by investing in a bond fund that purchases junior bank bonds. So BIPS is a collection of bonds from companies like those mentioned, which are all paying this steady level of income. We do make sure that we have this large diversification of bond issuers within the fund. So normally we have over 100 different companies, which is important for a bond fund because our returns are typically come more slowly from income. So we want to spread that downside risk across a variety of companies. I mentioned that one of the powers that BIPS has is the ability to set this dividend target, which means that investors know what to expect. So for the next couple of years, in terms of income, an investor buying today knows what to expect. That target is currently 12 and a quarter pence per share per annum. We pay that quarterly. That gives a yield on today's share price of around 7.2%. And I would add that the bonds within the portfolio today are generating BIPS a yield which is higher than that. So it's higher than that 7%, but we're choosing to keep some of that income within the fund so that we can reinvest it. Another important power that BIPS has is that ability to borrow money. I do think that some borrowing, when it's used carefully, it can be a very useful tool. And so for BIPS, it allows us to buy more of the bonds that we like. As of a few days ago, the current borrowing is around 8.5% of the funds on a net basis, net asset value basis, net of cash. That's a little lower than usual. We typically keep it between 10 and 15%. And when it can be really useful to have that ability to borrow is if there is a sell-off in the market. And bonds do trade in the secondary market. The prices move every day. In 2022, we went through a major repricing of bond markets, and it was not uncommon to see bond prices from good companies falling 20 or 30% or more. So having that ability to increase borrowing at a time like that in order to invest if we see opportunities is a really powerful tool for us to have. And as fund managers, my colleagues and I have over 2 decades of experience of managing borrowing through cycles. Then on top of that, to give investors reassurance, we have a risk team monitoring the fund, and of course the additional scrutiny and oversight that we get from having a board of directors at BIPS. The final point I would make on borrowing is that there is an upper limit which is set at 30% of gross asset value. So I will move on to the market now, and where's my market slide? God, there it is. As a few years ago, as I'm sure you know, bond yields were much lower across the board, and that was the main issue if you were looking for a higher level of income. Today, it is a very different story. Bond yields are much higher. A 7% plus income from a diversified portfolio of bonds is achievable. This chart is the yield on the European high yield market, which makes that point. It's been several years since we've seen yields like this in our market. So putting to one side that brief sell-off that we had during 2020, it's been around a decade. And as you know, in 2022, it was inflation that really changed that picture. Inflation, you have to remember, is the nemesis of bonds. That was a lot higher than most people had expected. That had coincided with bond yields starting the year at very low levels. So if you look at this chart, you can see even the high yield bond market in Europe offered an average yield of only 3.4% at the start of 2022. It's now just below 6%, which is obviously far more exciting for income investors. What I'm going to do next then is talk about a couple of examples of bonds to bring the market to life a little bit more. So let's start with, on the left-hand side of this chart, BT in the UK. BT needs no introduction, of course. It's a big blue chip stock. And when it comes to its bonds, the company is rated as investment grade. So that means the credit risks are relatively low at BT. This particular bond is what we call a junior bond from BT. And when this bond was issued in 2023, investors did need just a little bit more convincing to buy bonds in general. Inflation was proving a little stickier. And so even a company like BT had to pay this pretty attractive, pretty high coupon of almost 8.4%. For BIPS, that was a very nice bond to be buying, putting into the portfolio. And you can see here, we've also included the price. So the price today, just under 108. Most bonds are issued at a price of 100, and then they're redeemed at a price of 100. So that means not only have we earned the 8.4% income per annum, the bond has also made almost 8% in capital appreciation over the past 2 years. On the right-hand side of this page is a very different kind of investment, because this is a much smaller company, whereas BT was borrowing £700 million with this particular bond. The bond from Newcastle Building Society that we're showing is only £20 million in size. And because of that, it will trade less frequently in the market. It will attract a smaller group of investors. The ability to invest for the long term, though, that third power that BIPS has as an investment trust, means that we can really look through this and we can hold this bond knowing that we won't need to sell it unless we decide that we want to sell it, unless we change our view on Newcastle Building Society. So it's a business that our analyst is very comfortable with. He's met with the management team. He likes the key features and we're happy to be invested. If the same bond was issued by a nationwide building society, which is the largest in the world, that coupon of 12.25% would have been significantly lower. And so I really like the fact that BIPS can offer investors access to a bond like this that would be otherwise inaccessible to most. Over the page, I will just expand here a little bit more on the risk profile of BIPS and the BIPS portfolio. And there are lots of ways to think about the portfolio, how it's invested, but one of the key metrics that we use is the credit rating of the holdings. And we often talk about credit ratings in the bond market, and they are simply a rating of the credit profile of a company that has issued a bond. So much like a personal credit profile, it will be impacted by things like the amount of debt a company has, its size, the amount of cash flow that it makes. And the best quality credit profiles are referred to as investment grade bonds. They also offer the lowest yields as you would expect because they're deemed to be safer investments. And then as you move down the rating quality spectrum, you get to double B, single B, and triple C. And those ratings from double B and below are referred to as high yield bonds. So today, the BIPS portfolio actually has a lot more investment grade rated bonds than it has done for many years. And that reflects the higher yields today. So even from the investment grade market, we can earn more yield today than we could do. So 4 years ago, I checked earlier, 4 years ago, as of today in 2021, the sterling investment grade market, for example, was yielding below 2%. It's around 1.7%. Today, it's over 5%. And that investment grade part of the portfolio will perform better should there be an economic slowdown. But at the same time, the high yield bonds in the fund are paying more yield as to offer us more compensation for those risks. So weighing it all up, today when we're looking around the world, I would say there is uncertainty out there. There's uncertainty around inflation, around the impact of tariffs, and yields are a little lower than we would like to see with that in mind. So the portfolio is positioned more cautiously with about roughly around 1/3 invested in investment grade rated bonds and 2/3 in high yield bonds. So to conclude, we like the higher bond yields that are available today. If you're looking for steady income, then bonds can be I think, a very useful investment. The approach that we take with BIPS when we're putting together the portfolio is really about credit selection. We have a team of credit analysts whose job it is to meet the companies we invest in and help us to carefully select bonds for the portfolio. And then it's about diversification, as I mentioned. I've discussed the investment trust structure, but by being a closed-ended fund, it gives BIPS those extra powers, which I really like. So setting a dividend target, using some borrowing, and then this complete focus on long-term investing and not having to worry about potential redemptions or money being taken out of the fund. It's worth mentioning as well that the BIPS share price trades at a small premium to its NAV, which is great to see. But I think more importantly is that it has this long history of tending to remain in a stable range relative to its NAV, which I think for investors is very nice to see, it's very useful to see, and it gives you more confidence in investing. As I mentioned, the dividend target 12.25, 12.25 pence per annum is well covered today, and that gives us the confidence in setting that as an achievable target for the next couple of years. So thank you for listening. I'll wrap up there and I'm happy to take any questions.
Great, thank you. Let's just sort of pick up where you left off there. So, I mean, there's a few questions really about how sustainable the dividend is. So, can you just say, one, if rates fell a bit and the yields that you were earning fell a bit, would you maintain the dividend by sort of distributing some capital, or was that just a no-no? And secondly, if rates fell a lot, would the dividend come down?
Yeah, good question. So we are, yields are higher today, but they have been falling steadily since that peak in 2023. And they may continue to fall further. It's not quite as clear cut if rates fall, that all bond yields fall. It depends why rates are being cut. If it's to do with a, a more serious economic downturn, then the riskier part of the bond market yields there will have to move a little higher to compensate people for the additional credit risk. So it's not as clear cut as that, but certainly the direction has been for lower yields, and so we do have to think about the next few years. So that target today is based off a view for the next 2 to 3 years uh, in terms of the portfolio that we have today. So we can run that forward. And the great thing about having a bond fund is that we know what the income generation is of the holdings today for the next couple of years. Over time, those bonds will start to be redeemed, they will be maturing, and they'll be called. But for the next 2 to 3 years, we've got a pretty good picture. So that gives us confidence with the dividend target. Um, would we dip into capital? We haven't done. We've tried to avoid that historically. It did get very tough at the tail end of 2021 when yields were at very low levels and we were not comfortable investing in the market. So we've also got to think about that. It's all very well having a dividend target, but we've got to be comfortable trying achieving it with what's available to us without taking too much risk. So that's always a balance to be had as well. Even so, at the end of 2021, we were able to, just about able to cover from income. Looking forward, we do have some reserves. So this is the income that I mentioned that's being earned but is not being paid out. So there is the ability to dip into those first before we'd have to think about capital. So for the time being, I'm not concerned around that. But at some point in the future, if yields just continue straight line down, um, we'll have to keep thinking about how we do cover the dividend. But certainly dipping into capital is a very, very last resort.
Cool.
And we have the nerves to get through first.
Okay, great. That's brilliant. Just because there's like a lot of questions about falling rates. I suppose because of the rate cut yesterday. But
Yeah.
should investors, when they're looking at how the fund might perform, should they be keeping an eye on what the base rate is doing, what the short-term rate is doing, or should they be looking at what the long-term rate is doing, the sort of like 10-year gilt yield, for example? Where do you keep the maturity in the portfolio?
Yeah, that's a good question. I mean, that should be thinking about both. And we're not just invested in the UK market as well. So we're investing globally. There is exposure to the US, there's exposure to Europe, and there's some emerging market exposure as well. So we are thinking about that, and our job as fund managers is to really try and do that on behalf of the investor. So we can worry around the duration risk, we can worry about the credit risk, and try to put together a portfolio that achieves the income whilst managing those risks. The modified duration on the portfolio today is around 3.6. So that's a number which tells you if the yield on the portfolio was to fall by 1%, the price would rise by 3.6%. So it never quite works like that, but that gives you at least a reference point to think about the portfolio. That's relatively low compared to other parts of the bond market. So obviously, if you've got a 10-year bond, then the modified duration on that is much higher. The average maturity on the portfolio is a slightly different figure. It's around 4.5 years. So that again gives you a sense as to how long the current portfolio will be in place for, and we'll have to rotate it. So we're in a rate cutting environment at the moment. We saw another quarter point yesterday in the UK. We've now had 1.25% worth of cuts in a relatively short amount of time, and that will have an impact on the economy. There should be some benefit to the UK economy from that. similarly in UK, and the US and Europe. The challenge when we're looking at the bond market is to think about what is going on with the economy as well. So the riskier that the more we move down that credit rating spectrum, so into high yield, and the more we move down that part, the high yield spectrum, so from double Bs to single Bs to triple Cs, there is more exposure to what is going on in the economy. So if rates are being cut because the economy is tanking, then that's not good for that part of the market. If rates are being cut, and I think the Bank of England is actually doing a pretty good job of this. So if they're cutting rates to kind of to give a little benefit to the UK economy, but it's not panic stations. We've got some slightly weaker employment data in the UK, but it's not. There's nothing to be panicking about at the moment. If that's the situation we have, then it's kind of okay for most bonds. It's good for government bonds. It's good for credit, and it's okay for the weaker parts of credit. We really do think about when we're investing in that weaker part of the credit profile of the market, we're thinking about the potential risks ahead around the economy. So uh, investing in companies where we think that over the next couple of years they'll be able to cope if there is a weaker economic environment. So we're already thinking about those risks. But generally speaking, I think at the moment the biggest concern, if you're thinking about the bond market, is what is inflation doing? So it's a little stickier in the UK at the moment. It looks like maybe we're going to be popping back up to high threes for next year. It's not where we were at 10%, so that's good. But we do need to think about being in a potentially a slightly higher inflation environment, and what that means for us all having to get used to higher yields. So lots and lots of moving parts. We could have tax hikes coming, some kind of a fiscal event in the autumn. We could see more cuts in November because of that. So lots of moving parts. And like I say, for what I would like to think we can do with BIPS is to kind of take away some of um, that analysis from the end investor, and let us worry about the credit risk and the rate risk.
Yeah, great, brilliant. You mentioned earlier about the possibility of some borrowers calling their bonds. Can you sort of explain what that means? And there's a specific question about
Yeah, sure.
the possibility that the AT1 bonds, which I think are part of the bank debt structure, might get called early. Is that something?
Yeah. So for anyone that doesn't know as much about bonds, then yes, most high yield rated bonds will have a call feature. So that means the company can redeem the bond ahead of its maturity. So a typical high yield bond might have a maturity of 5 or 7 years, which means it's a contract to pay us a coupon for the next 5 or 7 years, pay us an interest rate every year, and then pay us back the money that we've lent at the end of that period. But the company might have a call option on that, which means after 2 years they could redeem that bond. Um, if we're in a world of falling yields, then you see uh, more bonds being called because that company will call it early and then refinance it with a cheaper bond. They don't. It's not the case that will happen to every bond that is callable. It depends on the situation for the company, the treasury team there, how they're thinking about managing their interest rate risk. Perhaps they don't want to issue a new bond just yet. Maybe they've got a view that they can hold off for a bit longer. There's all sorts of factors, but we will see bonds being called early in a falling yield environment. That creates reinvestment risk for us, so we have to manage that. Specifically on the bank capital market, it's a slightly different relationship there. So actually, the agreement that we enter when we're lending to a bank, buying a junior bank bond or a CoCo, as they're also known, um, the agreement is that they will be calling that bond on the first call date. So that could be 5 years, 7 years, or 10 years, and that they will call that on the first date. And if they don't call it, then actually you know, we complain. We don't like it because the original investment is based off it being that a bond that will be called at that point. So we would rather not see bonds, not the bonds from banks being called at their first call date.
Great. Okay, that makes sense. Thank you. Um, Obviously, you've got sort of credit risks in the fund. Have you actually ever had a fund? Sorry, ever had a bond run into trouble and actually default?
Yes. I mean, defaults do come. They come with the territory when you're investing in the higher bond market. So yes, we've had defaults in the portfolio. It's not quite as straightforward as that, though. I mean, the first point to make is that an analyst's job is to avoid walking into a default situation with an investment. So they need to understand the cash flows in a company, that company's ability to service its debt, to repay debt, and to be looking for any potential issues on the horizon. But we will also actively add to bonds or buy bonds of a company that are in distress, because as bondholders, we can take a company through a restructuring of their balance sheet, and there may be much more value on the other side than the bonds are worth today. So we might buy them at one price, hoping to make actually a decent profit going through a restructuring with that company. And we have experience of that within the team, and that can be a a, a benefit to the fund's performance just on the margin. And so it's something that we actively pursue and put into the portfolio. So I think the best response I can give is that a default doesn't mean a total loss. So sometimes it rarely means a total loss, and sometimes it can present an opportunity to make money for investors. But I think most importantly, that part of the portfolio tends to be low single digits at the most historically. So we're talking 2 to 3% of the portfolio at the peaks.
Yeah. Okay. And if you've got a situation where you want to sort of protect yourself, is there hedging that you can do, and do you actually use hedging in the fund?
There is hedging. It's always hard to hedge. Um, it's never as simple as it sounds when you think about it, when you go to put it on, or when you put it on. The hardest part is knowing when to take it off again. So, for example, I put a lot of hedging onto the portfolios before COVID hit, because we were very concerned about what we thought was coming. And we watched that protect the portfolio, and then we watched it also start to the hedge lose value again. And so by the time we took it off, it was probably back to making just a very small profit for the fund. But along the way, we were still very active in terms of buying bonds, and we had cash. Having cash is a great hedge against anything, an event that a sell-off in a market, because it means that you're ready to put that cash to work. Having the ability to borrow, I mentioned earlier, 2022, when we saw that repricing in the bond market, having that ability to borrow was actually very useful, because it meant that we could not only rotate bonds that we owned and buy bonds that were looking cheaper, we could also use some of that borrowing as liquidity. So it's not quite hedging, but it's kind of doing the same thing as having cash sitting there. We do use something called a credit default swap. That tends to be so that's essentially taking an opposite view on the market. So if you buy a credit default swap, then you are paying a small premium as an insurance policy, and that should move up in value if the market sells off. What we find is that it's a volatility product. So when volatility shoots up in the market, as it did post Liberation Day, the value of that instrument shoots up. And so we did have, because we have this view on yields being a lot higher, but still maybe a little lower than we would like to see versus the potential risks on the horizon. Because we had that view at the start of the year, we did buy some CDS for the portfolio. It was around 5% of the portfolio value. And then when the Liberation Day hit, we did take some of that off, but not all of it. And so now that protection is worth less today than it was at the start of the year. It's been a very volatile period from the start of the year, and so we're happy to hold it because we think that there could be some more volatility along the way before the year is out. But I go back to my point at the very start. It's tough to put a hedge on, and the hardest part of that is knowing when to take it
Yeah,
off.
exactly. Great. Um, with the gearing, so can you just explain how that works? Are you just borrowing a kind of like floating rate or fixed rates, or
So we will lock in a rate for 3 months, and that rate will be based off LIBOR or Euribor. So it's based off a 3-month floating rate with a small margin, and the margin is pretty low. It's about 0.3, 0.4% at the moment, and we borrow through something called repos, bond repos. So we'll take a bond within the portfolio. We'll go to a handful of counterparty banks that we use. These are very big banks, ask them to give us their best rate for us to borrow money against that bond, and then choose the best rate, and they will lend to us for 3 months. And at the end of the 3 months, we'll typically repeat the process and look for the best rate again. So there are maybe 20 to 30 bonds within the portfolio that we're currently doing that with. We retain all of the benefits, so the coupon, the income, the interest rate from that bond belongs to us, belongs to the BIPS. The only payment out is for the interest, and that is at the moment, I think we're averaging around 2.4%. So the borrowing cost is around 2.4% in euros on the bonds that we are borrowing against. So the banks will use that bond as collateral, and we've used repos in this way for a very long time. It's got a long history, a long track record. We've been through periods like COVID hitting, Liberation Day was a much shorter time frame, but when COVID hit, that was a pretty good test of a manager's ability to use borrowing in a sensible way. And we had no issues with access to borrowing or with the portfolio. And we use a handful of banks so that we're spreading that, spreading the counterparty risk, if you like. So the biggest risk that you'd face is a bank deciding that they're no longer going to be lending money via repos. And we've seen that in the past. So some banks have just withdrawn from the market for kind of high level strategic reasons. So very important to have that diversification. And we have that diversification of issuers that we are, bonds that we are borrowing against.
so you're getting quite a big yield pickup between borrowing at 2.5, 2.5, so and then what you invest in. So
Yes.
why? What is stopping you from having a lot more gearing in the fund?
Well, gearing amplifies the moves to the upside, but also the downside. So when we're more cautious on the outlook, then we'll keep that gearing a little bit lower. So we're below 10% today. That's a figure that's been picked up kind of for the presentation, and at that point in time, for whatever reason, the gearing looked a little lower than it typically is. So I'd like to keep it between 10 12% at the moment. That gives us a figure where we're comfortable that the portfolio we've got is sensible for possible risks ahead. I mean, we don't know what is going to happen, but just having a portfolio that is taking into account the possibility of those risks ahead, so weaker economic environment, that's what I'm talking about, that's quite important for us at the moment. And so having the gearing at the lower end of the range makes sense. We're still generating all of the income that we want and more. So I'm comfortable with it at that level. if there is a sell-off, Liberation Day was a good example. Actually, it was only a very short space of time, but we were active in the market, so we were buying bonds that had previously been trading typically 5, 6, 7 points higher, from names like Aviva, who'd recently issued a bond. We picked that bond up at a 5, 6 point discount to where it had been issued, and that's now back up at par. So having that flexibility to be able to borrow more than the 10, 12% is really useful for those times. So that's why we're keeping it a little lower at the moment.
Um, do you try, and are there sort of specific sectors? Again, we're thinking about things from an equity market normally, but as a bond investor, there's parts of the market that you like more than others?
Um, we are we do focus more on the individual credit story of a company. So, auto suppliers is a sector that has been in the press a lot because of it's kind of in autos are in the crossfire of all of this tariff noise and news that's happening out there. So, auto suppliers are, the people that make the parts for the cars, whether it's the wing mirrors or the components for engines. But actually, rather than shy away from that sector as a whole, we've got companies within that sector that we really like because they've got features that are less exposed to what is going on with global auto demand. So we own a company that's the largest manufacturer of lead acid batteries in the world. And when that goes in your car, you need to replace it. And even with EVs, there's still often a lead acid battery in the car. There's kind of a safety mechanism. So, great business for creditors because it's got this nice, stable, recurring revenues, and we're happy to have that in the portfolio. So that's an example of not shunning a sector because of a legitimate concern about the sector, but really focusing in on individual credits. So, yeah, more broadly speaking, I'm nervous, a bit more nervous on, say, the chemical sector at the moment. It's tough out there, and it's can be a very cyclical space, and earnings are not looking particularly good from the companies that we follow. So we're happy to take an underweight position, if you like, there. But there isn't anything that is really scary out there at the moment, sector-wise. There are some that we are more wary of, and then we're always finding, even within chemicals, there are some names that we're happy to hold because we think the balance sheet is very strong. It's got a fantastic management team that we really like, that we've known, Ineos, for example, we've known that management team for uh, over 20 years. Uh, they've been a part of the higher bond market for a very long time. Um, so yes, credit first, and then we can overlay a view of the sector onto that.
Great, thank you. There's a question, I don't know how you can answer it, but basically can you sort of draw a distinction between what you do and say what New City High Yield does and what 24 Income does? And actually, they are quite different funds to BIPS.
They are. So I would sum it up by saying that we're focused solely on bonds. So I think 24 do a lot more in terms of loans, and that gives them the ability to say that they've got a lot more floating rates exposure. So as in they're not the interest rate on the bonds on the loans that they own will move around according to uh, where rates are going. And so in 2022, that was great. Rates were rising, and rates rise, yields rise. So seesaw, bond prices fall, loan prices fall. Bond prices fall. But if so, they were protected there more than we were in the bond market. So we're bond only. They're doing some loans. Then I would say New City, I think, also have some equity in the portfolio. But I'm not an expert on
No,
what they're doing and what their funds look like. I try to just focus on what we're doing with BIPS, which is investing in the bond market and focused on that, getting that decent level of income that we've got confidence in to be able to give a dividend target.
So one of the things that's nice to see, I mean, the fact that you're trading at a premium, so you're issuing stock, and the process of issuing stock at a premium is also helping the NAV, which is all good news. I mean, compared to the amount of money you run generally, is this relatively small part of it?
It's getting bigger. We used to say, it's a relative, it's a small part of what the team manages as a whole, but we're now up to over 400 million of portfolio size. So for me personally, I manage three funds, totaling 4.5 billion, and so this is 400 million. This fund is 400 million of that. So BIPS is now, we're reaching that point where it's the size of the holdings it means that it's starting to stand on its own 2 feet in terms of size within the markets that we're investing in. So within the higher bond market, it's not a small fund piggybacking off our big funds. It's getting bigger, and it's great to see the issuance that we've had. We had a share placing at the start of 2024, which raised about 13 million pounds. That was brilliant. But actually, in June and July, across those 2 months, we've raised more than that just through daily dripping into the market through share issuance every 2 to 3 days. So it's great. I think I'm hoping that people understand or are appreciating the steady income that the portfolio generates, the fact that we will manage the credit risk, the interest rate risk, and I think also it's that confidence in the NAV. So part of the reason we trade at a premium is, I believe, because our NAV is marked daily. The bond market is liquid on the whole. People can have confidence in the bond prices that have made up the NAV on a daily basis. And so it's reassuring for investors, and I think that's why we traded at a premium. And I we've got some good momentum at the moment in terms of issuance, which I hope stays, because the bigger we grow, then the better the economies of scale for everyone who's invested.
This question just popped up about why buy fund versus a sort of high yield index. Can you just explain the unattractive issues around buying an index of bonds?
Yeah, I mean the index. It's not that easy to buy an index, but the difference I think between bonds and equities is that if you buy an index of bonds, then you're buying, you, know, you but there's no active management going on, but you are pretty much buying that yield today, and that is what you will get in terms of performance. So you might have a bond within there which has a fantastic year. Operationally, its price trades up. An active manager might look to sell that bond to move into something else and to take some profit, whereas an index, that bond will go up in price, and then eventually it will travel back down to 100 at the date of maturity. So an active manager has the opportunity to really take advantage of the volatility that we're seeing in the market. So, Liberation Day was a good example. I think we're going to have more periods like that over the next couple of years. So having a fund where we can very quickly shift, so sell some of those better quality investment grade bonds within the portfolio that will move less in the downturn, and then invest those into something, a bond which is traded off more that we really like and is now looking far more attractive. It's having that ability, and then of course we've also got with this fund, we've got the ability to borrow. We've got the ability to use that to enhance returns. So I think there's enough features, and being an active fund to kind of stand up and say, well, it does stack up pretty well against what you could get um, with a passive vehicle. And also the split that we have, that 30% investment grade, the exposure that we have to the bank capital, it would be quite hard to construct that passively, and it'd be quite hard to then manage that in the way that we can.
Yeah, exactly. Brilliant. I think we've covered an awful lot of ground. Thank you very much for doing that. We've got a
Thank you.
performance side up there, which are important, so people can go back and have a look at it. And the very important disclaimers again. Please do look at those. We always get the question, so I'm going to ask it as we finish up, about sort of skin in the game. So do you have an investment in the fund, and is it decent size?
Yeah, I do. Yeah, I have it in my pension. I have it in my deferred bonus. So not all of our bonus here is paid up front. It comes over 4 years. So every year I will put some of my deferred into BIPS. And my wife and my 3 children all have it in their ISAs.
Thank you very much indeed. So thank you for that, Rhys. All very interesting, and we will get you back again soon, I hope. And in the meantime, everybody, thank you for tuning in today. Do have a good weekend. We will be back next Friday. I'll be talking to Craig Martin, who's the manager of Vietnam Holding. And so in the meantime, I hope markets treat you well. Bye-bye.
Thank you.